Silver traders are watching two clocks right now, Shanghai and COMEX, because the next stretch of February lines up several real mechanical pressure points in the same week. Before we get into it, please remember this is informational only and not financial or investment advice. Here's the setup. Shanghai's futures market goes into its Spring Festival shutdown from February 15th through February 23rd, then reopens on February 24th. And 3 days after that, on February 27th, the COMEX March silver contract reaches First Notice Day, the point where delivery stops being a talking point and becomes paperwork. That doesn't guarantee a big move, but it does change incentives. When a major venue pauses and a major contract hits a delivery milestone, traders tend to tighten risk, watch spreads more closely, and react faster to surprises. To understand why this timing matters, you have to start with what silver really is, because it trades like more than one thing at the same time. Yes, it's a metal people reach for when they're nervous. But it's also a working industrial input, especially in electrification. That's a big reason why the China angle keeps showing up in the silver story. China remains central to the global build-out. Industry reporting suggests China's 2026 solar additions could still land in the hundreds of gigawatts, with forecasts like roughly 180 to 240 gigawatts, and some ranges higher. And on the vehicle side, silver demand tends to rise with electrification, not because silver is in the battery, but because EVs and charging infrastructure use more silver in electronics, contacts, and power systems. That's the key point. Industrial demand is different from speculative demand. Industrial consumption doesn't always sell back when sentiment turns. It can stay steady even when price action gets messy. Now that brings us to the export story, which is where a lot of commentary gets heated, and where it's important to separate what's confirmed from what's being assumed. Reuters reported China named 44 companies allowed to export silver for 2026 to 2027, based on a Ministry of Commerce statement. But that does not automatically translate into a sudden cutoff. Reuters also reported China shipped about 5,100 metric tons of silver last year, the most since 2008, and said major new export restrictions on silver have yet to emerge in the dramatic sense. So the honest headline is this: there is an export licensing regime. But the idea of an instant total chokehold is not confirmed by the best reporting. Even without dramatic restrictions, you can still get real friction. And that's where pricing can start to look unusual. At points this year, the China-linked price has shown unusually large premiums. One widely cited example pegged the gap around $17 per ounce at the time. That doesn't mean the world has permanently split into two silver prices, but it does tell you something practical. When logistics tighten, financing costs rise, or local demand surges, arbitrage doesn't always close the gap immediately. Dislocations can last longer than traders expect, and while they're open, volatility tends to rise. Now overlay that with how silver trades in the paper arena, because paper mechanics can amplify moves in both directions, and one lever matters more than most people realize: margin. On February 6th, CME raised silver's margin, or performance bond requirement, to 18% from 15%. In plain English, that means if you're leveraged, you may need more cash to hold the same position. Some traders reduce risk, and depending on how crowded positioning is, that can trigger sudden drops or sudden squeezes. That brings us to the inventory headlines, because this is where a lot of people jump to conclusions. Reuters noted COMEX silver stockpiles falling. One reference point described a drop from about 532 million ounces to 418 million ounces over a cited period. That matters, but the labels matter too. Total inventory isn't the same as registered inventory, which is the deliverable category. And one more common misunderstanding: open interest isn't banks short that amount. It's total outstanding contracts, always paired long and short. So the clean framing is this: falling inventories and delivery mechanics can be stress signals, but they are not, by themselves, proof of a default. Now, put that back into the calendar window. Shanghai is closed February 15th to 23rd, reopens February 24th, and COMEX March First Notice Day lands February 27th, with margins already raised. That combination can tighten liquidity and magnify reactions. This doesn't promise a system break. It does raise the odds of volatility, because silver is extremely sensitive to timing and positioning when multiple mechanics line up. If you're tracking this buildup, here's the checklist. Watch Shanghai versus Western pricing for dislocations. Watch margin updates for forced deleveraging risk. Watch COMEX inventories, especially registered versus eligible. And keep the demand mix in view, industrial versus investment, because that shapes how silver behaves when sentiment turns. Thank you for watching, and please like and subscribe to support the channel.